Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Breton Technology Co. Limited annual report. Breton Technology Co. Limited market capitalization of $8 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Breton Technology Co. Limited holds a significant advantage in their industry. Breton Technology Co. Limited trades at a higher price-to-book ratio of 9.16 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 53% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The net income of the company experienced a significant decline between 2024 and 2025, decreasing by 14.3%. This means that despite efforts to improve profitability, the company still incurred a loss, albeit slightly smaller than in the previous year. However, there was a notable improvement in profit margins during this period. The profit margin increased by 5.3 percentage points, rising from 5.8% in 2024 to 11.1% in 2025. This suggests that while the company's net income decreased, its ability to generate profits from each unit of sales improved significantly. The company's financial performance indicates a significant issue with its operating cash flow. Despite generating some revenue, the company is unable to produce positive operating cash flow. In fact, the data shows that operating cash inflows have been consistently lower than operating cash outflows over the past 2 years. In 2024 and 2025, the company's operating cash inflows were RMB 1,244,319 and RMB 1,433,419 respectively, while its operating cash outflows were significantly higher at RMB 1,943,119 and RMB 2,111,919. This trend suggests that the company is struggling to manage its expenses effectively, resulting in a net loss of operating cash flow. This situation raises concerns about the company's ability to sustain itself financially, as it relies on external funding or other means to cover its operational costs. To turn things around, the company needs to focus on reducing its expenses and improving its revenue streams to generate positive operating cash flow. The company's debt level has undergone significant changes over the period. Total liabilities have increased by a substantial amount, rising from RMB 756.1 million to RMB 1,440.2 million. This growth is largely driven by an increase in loans and borrowings, which rose by 104.7% from RMB 352.3 million to RMB 721.5 million. Furthermore, current loans and borrowings have increased from RMB 167.2 million to RMB 496.7 million, while non-current loans and borrowings have risen from RMB 85.1 million to RMB 224.8 million. The increase in debt level has also led to a significant rise in interest expenses. Finance costs have increased by 104.6%, implying a substantial hike in interest expenses. Specifically, interest expenses on loans and borrowings have grown from RMB 93.36 to RMB 13,366, representing an increase of RMB 40.30. This suggests that the company is now paying more for its debt obligations, which may impact its profitability and financial stability. The performance of various segments in the industry has been mixed, with some showing significant growth while others have declined. One segment that stood out for its impressive performance was battery electric wide-body dump trucks, which saw a substantial increase of 77.2%. This suggests a strong demand and adoption rate for this type of equipment. On the other hand, several segments struggled to keep pace. Battery electric loaders experienced a significant decline of 56.9%, while battery electric tractor trucks plummeted by an even steeper 84.7%. Additionally, spare parts and accessories saw a modest decrease of 4.8%. These results indicate that certain types of electric equipment are gaining traction in the market, but others may require further development or marketing efforts to improve their performance. Management is optimistic about the company's outlook and strategy. The goal is to become a dual leading technology enterprise in new energy mining equipment and unmanned solutions. To achieve this, the company will focus on scenario-based tiered implementation, product matrix upgrades, and overseas expansion. Key strategies include developing tiered intelligent mine demonstration projects and achieving mass production of autonomous mining trucks. Research and development will be intensified to develop specialized mining trucks for different scenarios and expand into new markets in emerging mineral regions. Partnerships with major state-owned enterprise customers will be established, and an industrial ecosystem for mining autonomous driving will be built through full-chain collaboration. The company is also expanding its PV storage and charging energy business internationally, with significant investments allocated to this effort. Management believes the company has sufficient resources to continue operational existence in the foreseeable future, thanks to committed financial support from the controlling shareholder. Concerns about inventory buildup and supply chain disruption are emerging in the industry. One of the primary concerns is inventory buildup, as data shows a significant increase in finished goods and raw materials inventory from 2024 to 2025. Finished goods inventory rose by 68%, while raw materials inventory increased by 29% during this period. This buildup could potentially lead to supply chain disruptions if not managed properly. The industry acknowledges the risk of disruption, with measures being taken to mitigate it. Furthermore, specific actions are being implemented to address potential issues, such as providing increased deposits to battery suppliers. These efforts aim to prevent or minimize the impact of any disruptions that may arise from inventory buildup and supply chain vulnerabilities. That concludes the financial summary for Breton Technology Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.